In today's video, I'm going to be going over an example of a stop hunt that occurred during the London session. And without further ado, let's do this. So first of all, here's an example. It is a still image, but this is a real example. So what we have here is that we have a day. Right here, we have a day demarcation, okay? And this is the previous day, okay? This gray section, it is the Asia session box. This gray section here is also the Asia session, which means that the candles between 10 p.m. and 7 a.m. have been summarized in one gray area, this box. Okay, if you want to know what indicator I used to summarize the Asia session, make sure that you leave me a comment in the comment section. Okay, so how do we capitalize on stop hunts that happened during the London session? So once again, here we have the Asia session. Okay, during the Asia session, the market usually consolidates and accumulates orders. Okay, the price contracts and the volume is pretty low during the Asia session in comparison to the London session, as you can see right here. Okay, so this is the Asia box low. This right here is liquidity. What do I mean by that? Each time there's a swing high or a swing low, there's an accumulation of orders, which means that institutions and also retail traders all over the world are actually placing their orders, buy stops, sell limits, sell stops at each low and each high of the day and also the Asia session. Okay, that's what happens in the Forex market. Each of these swing lows have people placing orders in hopes of making profit. Okay, so we have that also over here in this section right here. These are the orders of people and small institutions all over the world, which we call liquidity. Okay, this section in purple is liquidity. This section here too is also liquidity. So I just put that on the chart so that you can visualize it. So now, what do we need? We need to see the first move out of the London session. So the first move out of the London session right here. Okay, so this is 8 a.m. Pay attention and look at your charts. Around 8 a.m. is usually when London session stop hunts usually occur. If that's a stop hunt, it usually occurs around 8 a.m. Go on back test your charts and you will see what I am talking about. We need to identify a demand zone, okay, below the Asia session. Right here, this blue dotted lines right here, this is the wick rejection demand area, okay, right here. It's a demand zone on 1H time frame. It's a demand zone right here. It is a demand zone that had a strong impulsive move. This move right here was an impulsive move. Okay, that impulsive move showed us that the market makers actually pushed the price to the upside. When the price returns and staggers back to the area, that's called mitigation. So the market makers, the people who have enough money to actually push the price in a certain direction, they're called the market makers. So when they push the price in a certain direction, the price needs to rebalance itself. There's a lot of imbalance created in the Forex market. So the move to the downside is called mitigation. Okay. And after the Asia session accumulation occurs around here, this market makers have an algorithm which shows them where the liquidity is in the Forex market. So what did they do? They, around 8 a.m., they pushed the price to the downside. You know, the volume, if you have a volume indicator, you will see that the volume increases around 8 a.m. The move happened very quickly. And around 8 a.m., the liquidity was grabbed from the Asia low right here, and also the daily low around here. So this red arrow shows the day and Asia box low. Okay, so all this is grabbing all the liquidity that was placed around here, which is stop losses, basically speaking, people's hard-earned money. Okay, that is liquidity. Okay, grabbed over there and grabbed over there. When they take that liquidity, a percentage of that liquidity and people's money gets transferred to them. Okay, so once the price actually moved and stop hunted all these levels, around here is where we enter. This is where we enter. I'm not going to go into exactly how to enter the market, but this right here on a smaller time frame, around 3M or 5M or 1M, depending on your strategy, you can enter the market around here. This week right here, it is the London session liquidity grab that happened right here. And as you can see, once that move happened, they moved quickly within 2-3 hours, went to the upside. Okay, so this is a fake out. A fake out is a move that traps, in this scenario, trapped sellers. So it was actually called a bear trap, because once the price went to the downside, the people who put their orders that, okay, cool, once the price breaks this level, automatically they're going to be in the trade. So those sellers actually got trapped by this liquidity grab. And take profit is going to be, so your first take profit is going to be the Asia high right here, and then you can move your stop loss and then let the trade accumulate more profit for you. So that right there is an example of stop hunt example in the forex market. Okay, I hope that you found this very valuable. Please leave a comment, like this video, and do not forget to subscribe to this video. I am Toxibility FX, and I'll see you guys in the next one. Thank you for watching. Take care.